Here's the agenda. In this short video, I'll discuss the following 3 topics. Topic number 1. What are the definitions of call and put options? Long and short position. Initial cash flow, right and obligation of various positions. Topic number 2. What are the payoff and the profit loss function for call and for the put? Using Excel, I'm going to show you their related graphs. What are the expectations for various positions? The last topic will be various trading strategy. Our tool will be Excel. Note, for this video, there's no math, just basic Excel. For the next 2 videos, Introduction Black-Scholes Merton option model and Binomial tree option model, we will have some formulas. For a call option, for a call option buyer, he or she has a right to buy something like stocks, bonds, or some commodity in the future with a predetermined price. Put option. For a put option buyer, he or she has a right to sell something in the future with a predetermined price. The next table shows us the right versus obligation and cash flow. So let's look at the call option first. So this is call option. We have 2 positions. Buyer, sometimes we call the long position. Seller, we call it short position. For the call option buyer, right, and initial cash flow is cash outflow. Okay, for the buyer, cash flow is always pay. They pay to have a right, so they have a right both ways. When they sell, for the seller, they have obligation. They have cash inflow. At the same time, they have an obligation. Buyer is called long position, seller called short position. You pay, you have a right. You have cash inflow, then you bear obligation. The 2 definitions of, generally speaking, the American option versus European option. For a European option, the option holder can exercise his or her right only at maturity. This is only time they can exercise. For American option, the option holder can exercise anytime before or at maturity date. Let's assume the option is on the stock. Payoff and the profit loss function for a call option buyer. We have 2 prices. One is called ST, is terminal price. Another is X, called exercise price. Recall, for a call option buyer, his or her right is to pay this X to purchase a share. Assume X is 10. When the terminal stock price is 12, the buyer will exercise his or her right, and the payoff is 12 minus 10 is $2. When the terminal stock price is 9, the buyer will not exercise his or her right because they can purchase this stock cheaply. Then we have the payoff function. Is max st minus x, comma 0. So if st minus x is positive, then we have positive payoff. The profit loss function is simply the payoff minus how much he should pay is minus C. The payoff and the profit loss function for the put option buyer. Again, we assume the exercise price is X, and X is still 10. When recall, for the put option buyer, they have a right to sell their stock at $10 in the future. When the stock price is 9, the terminal stock price is 9, then buyer will exercise his or her right. So 10 minus 9 equals 10. The payoff, 10 minus 9 is 1. The payoff is 1. If stock price is 12, the buyer will not exercise his or her option because if they want to sell, they can sell at 12 instead of 10. So the payoff function for the put option buyer is max X minus ST, 0. The profit or loss for the put option buyer is simply his or her payoff function minus P. P is cost of the put option. Next, let's use Excel to draw the graph of the payoff function and profit loss function for the call option buyer. Let's assume exercise price is $40. The call premium actually is how much they pay to purchase one call option is $2. So let's enter ST. So this is terminal stock price 0 and 5. We use $5 as an incremental value. Copy and paste. So this is payoff. Payoff for a call option buyer. Okay, so remember it's max stock price minus exercise price. We hit F4 to fix it, fix the location of the cell. 0. We copy and paste. To draw the graph, we highlight both. We click Insert. We click Recommended Charts. Then this is our payoff. So this is our payoff. Okay. So let's calculate profit or loss. So profit loss function is simply, for the long position, is simply the payoff minus the cost, the premium to pay. We hit F4 to lock the location. Okay. When the stock price is 0, the long position will not exercise, and he or she will lose initial investment of $2. So let's draw the graph. Okay, we highlight terminal stop price, hit Control, hold the Control key, then highlight profit or loss to simply insert recommended charts. Then we have this one. So actually, this second one is identical to the first one. The only difference is the whole graph moved down by 2. Okay, so this is not very clear. So let's say it's big. So actually, it's $2 difference. Okay. So this is payoff for the call option buyer. So the $40 is start, the long position holder will exercise. And so here, so actually it's $42 is break even point. For a put option holder or long position, we can do exact same things. Okay. So again, so let's assume exercise price is still 40. and the put premium. So let's make it a little bigger. So it's 5, and we do the same thing. ST 0, 5 as incremental value. Okay, we draw this one. So this is payoff for the put. Okay, so equal max is exercise price minus terminal stock price and 0. Okay, it's 40. Before we copy paste, we have to log the exercise price. Hit F4. Then, so let's profit loss. The profit loss is simply payoff. So payoff minus the cost. P. Hit F4. Log it. Okay. So let's only show the profit loss. Highlight terminal stock price, profit loss. Hold the Control key. Okay, recommended. So this is our profit loss function for the put option long position. Okay. So if we want to draw the payoff, highlight both columns, insert, recommend chart. Again, they're identical. Okay, here is 40, and if below 40 and put option holder is going to exercise his or her options, the break-even point will be $35. Okay, so this is break-even point. So this is break-even point, $35. So far, we only discussed the payoff and the profit loss function for a long position. For a short position, just remember one concept. This is a zero-sum game, so we simply add a negative sign. That's it. You see, for the first this part, this is for the call option long position. For the short position, we only for the for the payoff, we add a negative signs. For the profit loss, we add a negative signs. So this is for the put option long position. For the short position, we add a negative sign. That's it. On the top left, so this is a profit loss call. It's a long position. Okay. To make it more meaningful, we exaggerate the premium. Okay. So this is profit region, and this is loss region. So this is profit or loss for the put option. So this is a long position. When the stock price is less than exit price, we assume exit price is 40. So 40, 40, and 40. Okay. So this is the profit loss for the long position. Top and the bottom. So this is a long position, this is a short position. And similarly for the put, this is long position and this is a short position. Another purpose to show these four graphs is our expectation. Suppose we expect stocks going up. Stocks going up, so this is a profit region, so we can long a call. So this is profit, okay. For this one, put. Okay, so this is profit region. If the stock's going up, then we can short a put. The stock going up, we can long a call or short a put, because these are profit region. This is also profit region. When the stock going down, we expect stock going down. See from here, so this is profit region, stock going down. Okay, we just assume today's stock price 40, 40, stock going down. Okay, Then we can short a call. Alternatively, we can long a put. There are many different trading strategies with options. Okay. And we are going to talk about straddle. Okay. Buy a call and a put with the same exercise price. So here is mentioned what is the meaning of this one. A straddle is an option strategy involving purchasing of both a put and a call for the same expiration date and the strike price on the same underlying security. We are going to use Excel to implement this trading strategy. We assume exercise price X equals 40. The call premium is $2 and the put premium is $3. So this column is terminal stock price as T. Start from 0. So 5 will be our incremental value. So the first one is payoff, profit or loss. This is for a call. Okay, the profit loss will be payoff max stock price, terminal stock price minus exercise price. Hit F4 key to lock it, comma 0 minus put premium. Again, F4 to lock the sale. Okay. When we do not exercise, we lose $2 initial investment when stock price is 0. So this is profit loss for the call. So this is profit for a put. Okay. Its payoff for the put option is exercise price, hit F4 minus terminal stock price, comma 0 minus initial investment. So we hit F4 again, enter. When the stock price is 0, we exercise, we got $40 minus initial payment 3 is 37. And double click. Okay, so this is our portfolio. So this is profit loss portfolio. So our portfolio is we long a call and long a put. Then it's simply the summation. So this is the profit loss from call. This is the profit loss from put. So this is our final profit loss payoff, profit loss function. Okay. So let's draw a graph. We highlight terminal stock price, hold control key. So this is our profit loss, and insert recommended. So this is our final result. So when the stock price increase, we exercise our call. So we have a positive region here or positive region here. If the stock price is going down, we exercise our put. So this is a positive region and this is a positive region for the put. When we lose, when stock price here, we are going to lose our initial investment. For this straddle strategy, we buy one call and one put with the same exercise price. We assume they have equal probability, stock price going up or going down. Suppose we have a good chance, we expect stock price going up, have a high probability stock price going up compared to stock price going down. Then we might buy 2 call and 1 put. Okay, so actually we can just keep this intact, make it much easier. So this is number of call we are going to buy. So this is number of put we are going to buy. Okay. If we use 1, then we have the same graph. Okay, so this is our portfolio. So this is how many call we hit F4 times call profit plus the number of the put times corresponding put. We will not see any changes because this is 1 and 1. Okay. For the strip, we increase this by 2. You see this one changed. Okay. For this strategy, so this is 1, then this is 2. That's it. We have high probability stock going down compared with the probability stock going up. This is the last example, so-called butterfly with calls. Our trading strategy is buy 2 calls with X1, X3 as their exercise price, and sell 2 calls with X2 as their exercise price. X2 is simply the average of X1 and X3. Let's assume X1 is 30, X3 is 50. So this is simply its average is 40. We just assume some premium. Okay, when the exercise price is low, the premium should be high. So randomly choose 5, 3, and 1. Okay, so this is the stop price, and so this is the profit of call, long position, long position, long position. Okay, so this is our portfolio, profit and loss of our portfolio. This is our last exercise, so-called butterfly. We can construct butterfly strategy with calls or with put. So let's use calls. We are going to buy 2 calls with X1, X3 as the exercise price and sell 2 calls X2. So X2 is the average of X1 and X2. We have initial cash outflow. So this is outflow. And so let's assume X1, X3 are 30 and 50. So average will be 40. And when we have a lower exercise price, premium should be higher. Okay, it's 6, 4.7, and 4. So this 2 is higher than 6 plus 4. So this we have initial cash outflow. Okay. So this is profit or loss for the first option, equal max stop price minus exercise price, F4 0 minus C1. So hit F4 to lock the sell. Similarly, so this is max stop terminal stop price minus X2, F4 0 minus C2. Hit F4 again. So this is the third call. Max terminal stop price minus exercise price, X3. Hit F4 0, close it, minus C3. We hit F4 again. So this is the profit or loss for our portfolio. Again, our portfolio long 1 call, long another call with exercise X3, short 2 call with exercise X2. So this is long x1 call plus x3 call short. Short is minus 2 times corresponding profit or loss. Okay, then we copy and paste. So let's draw the graph. Okay, so this is terminal stop price column, hold control key. This is our final profit or loss. Click insert, click recommended. Then so this is our butterfly. So this is our profit or loss region. Okay, so if the stop price around x2, so this is 40, then we profitable based on this trading strategy. If stop price going up or going down, we are going to lose our initial investment or premium.
Shutterstock Music.